Have you ever looked at a stock chart and wondered, should I use a put credit spread or a call credit spread? Choosing the wrong strategy can put the odds against you before you even place the trade. The good news is that the decision is actually very simple once you understand one key idea. It all comes down to whether you're bullish or bearish. Let's start with the put credit spread. A put credit spread is a bullish option strategy. You use it when you believe a stock will move higher or simply stay above a certain price before expiration. For example, imagine a stock is trading at $100. After looking at the chart, you believe the stock has strong support around $95 and is likely to stay above that level over the next month. You could sell a $95 put option and buy a $90 put option. When you open the trade, you immediately collect a premium. If the stock stays above $95 until expiration, both options expire worthless, and you keep the premium. Notice that the stock doesn't have to rally higher. It can move sideways and it can even fall a little. As long as it stays above your short strike price, the trade can still be profitable. Now let's look at the opposite situation. Suppose that same stock has been falling for several weeks. The trend is clearly lower and you believe it will remain below $105. Instead of using a put credit spread, you could sell a $105 call option and buy a $110 call option. This creates a call credit spread. Just like before, you collect a premium when entering the trade. If the stock stays below $105 through expiration, you keep that premium. So the difference between these two strategies is actually very straightforward. A put credit spread benefits from a bullish outlook. A call credit spread benefits from a bearish outlook. The real question isn't which strategy is better. The real question is which strategy matches the current market trend. Before entering any credit spread, spend a few minutes analyzing the chart. Is the stock making higher highs and higher lows? Is it trading above the 20-day and 50-day moving averages? If the answer is yes, a put credit spread may have the higher probability. On the other hand, if the stock is making lower highs and lower lows and trading below those moving averages, a call credit spread may be the better choice. Another important factor is implied volatility. Higher implied volatility usually means higher option premiums, allowing you to collect more credit. However, it also means the market expects larger price swings. Higher premium may sound attractive, but it also comes with greater risk. That's why successful options traders never choose a strategy based only on the amount of premium they can collect. One of the biggest mistakes beginners make is forcing a bullish trade in a bearish market, or a bearish trade in a bullish market. Instead of asking, which strategy do I like? Ask yourself, what is the market telling me? Then choose the strategy that aligns with the trend. Before we finish, here's the framework I want you to remember. If you're bullish, think put credit spread. If you're bearish, think call credit spread. Don't choose your strategy based on the premium. Choose it based on the direction of the market. When your strategy matches the trend, you immediately put the probabilities more in your favor. Remember, successful options trading isn't about predicting every move. It's about building a framework for making high probability decisions, one trade at a time. That's it for today, traders. I hope you found this video valuable. If you did, hit the subscribe button and turn on notifications so you never miss an update. Leave a comment below and let me know your thoughts on this video, or tell me what options trading topic you'd like me to cover next. Your support means the world to us. See you in the next one.